Yeah, good afternoon. So today we are going to discuss the important topic in financial management. It is under, I'm audible, sir. Hope I'm audible. So financial decisions, and today we'll continue with previous class, capital structure decision, capital structure. So in last class, I was explained about the difference between uh, capital structure and the financial structure. So financial structure is consists of total liabilities of a balance sheet, whereas the capital structure consists of only these long-term capital and debt of a firm, right? So capital budgeting, there are different theories are there, either relevant theories and irrelevant theories are there. Suppose here we are discussing one by one capital structure theories. Under capital structure theories, first one is net income approach, traditional approach, net operating income approach, Modigliani-Miller approach, trade-off theory, and picking order theory is also there in capital structure decisions. So capital structure decisions also talked about the relationship between EPIT and EPS, earning before interest and taxes, and EPS analysis also is a part of capital structure decisions. Right? Capital structure decisions refer to the deciding the firm financing which the source can be tapped. Either they can go for debts, or they can go for equity, or they can go for mix also. Right? Which which option, which combination are increasing the value of the firm and minimizing the cost of capital, right? So we totally financial structure, capital structure theories we talked about. What kind of combination is required for increasing the value of the firm and decreasing the cost of capital, right? In previous class, we talked about this capital budgeting decisions, and here capital decision we already the firm can be replace the existing plant and buildings or uh, technology, introduce a new modern technology, and modernization of this plant and expansion of the firm, right? Either horizontal, vertical, or the firm can be diversified, entering a new market, new products with new styles that can be possible. What's the need for fund? They want to raise the funds to do all these or any one of these, right? They can mobilize through internal funds, through retained earnings, or else the firm can go for debts, or the firm can be issue of equity shares. One option is retaining earnings. They are whatever the profits are, the firm is generating. These profits are retained the firm to do this either replacement of modernization of diversification of the firm, entering a new market and with new products, with new technology. They required funds. The three sources either they can mobilize through internally nothing but retained earnings, or the firm can issue debts, debentures or bonds, or the firm can issue IPOs or public follow-on offer also they can issue. Here the capital structure decisions, existing capital structure and desired debt equity mix, and what is the payout ratio of the firm? How much dividend the firm has to pay to its shareholders, or they need to retain. So desired capital structure, a combination of both. See the trade-off between effect on return, effect of the risk, right? So this is existing capital structure. Now the firm has to revised and desired debt, debt equity mix. As I told you earlier, debt is always cheaper source, right? If the firm either raise the debts, what's the impact of impact of returns? What's the impact of the firm risk, right? And if it is a growing firm, if the debt is increased, the risk is not that much as compared those firms are not growing firm is a what we call normal firm, decline firm, but we see the firm is suffering for debts. And effect on, you see that effect of cost of capital. Right? Debt is a cheaper source. The firm issue the debt, issue these debentures, the cost is lesser instead of comparing the equity. Equity shareholders are expecting higher return compared to this debenture holders. And the firm has constructed optimum capital structure where the firm value is maximum, the cost of capital is minimum. So this is the hierarchy. We require the firm require the funds for doing these, how they can mobilize it through internal funds, debt, or external issue of equity, or either they need to revise it, desired capital debt, and the payout ratio impact of if we can firm can decide debt equity means what is the impact of debt and equity and effect and cost of capital. And if the firm is construct a good optimum capital structure, the value of the firm is minimized, the value of the firm is maximized, and cost of capital is minimized. Now we talked about one by one capital structure theories. The first theory is capital theories. We discuss capital theories are capital structure relevant theories and irrelevant theories. Relevant theories means what? Whatever the changes, right? Changes if the firm is issue the debts more and more, right? Cost of capital is minimized, value the firm is the here in this relevant means whatever changes happening in the capital structure reflect the influence in this KO cost of capital and value of the firm. These NI approach and traditional approach, these tourists say that if the firm issue this higher debt, naturally the KO is declined, value of the firm is increased as per this relevant theories. But whereas this capital structure theories are irrelevant, there is no influence. Either you can issue the more debts, right? If you issue the more debts and there is no influence, KO and V. KO and V. V nothing but value the form. These two theories say that there is a relevant theories are there. These theories are there, not relevant. There is no impact in this KO and V. Whatever the change is happening in the capital structure, there is no influence as per this NI and NOI approach. Sorry, NOI and MM approach, modeling approach. So like that, in capital structure theories are divided into two relevant theories and irrelevant theories. Okay, now we will go for one by one. The first theory is net income approach theory. So this theory says that the capital structure decisions is the relevance of value of the firm. Increase in leverage means increase in the debt will lead to decline the weighted average cost of capital. So this theory says that if the firm increase the debt, leverage nothing, financial increase the debt. So if the firm is increasing the debt capital, right, decline the value of the firm, decline the weighted average cost of capital, and increase in the market ordinary shares increase. Value of the firm increase. Decrease in the leverage cause increase in the overall KO. And consequent decline in the value of the firm as well as equity shares. Equity shares. So this theory, as per NI theory, mentioned that there is a relationship between capital structure changes, whatever changes in the capital structure that leads to either increase the KO or decrease the KO and increase the value of the firm or decrease the value of the firm. There is a close relationship between these. Okay, the value of the firm on the basis of NI approach we ascertained as follows. V is equal to value of the firm. How we calculate the value of the firm? KO market value of the equity plus market value of debts. Okay. Both will considered market value of equity plus market value of debt equal to value of the firm. Overall KO, how will we calculate? We calculate the value, overall KO, cost of capital, EB80 by value of the firm. EBA nothing but earning before interest and taxes divided by value of the firm. Already we calculated here value of the firm, right? Value of the firm and EB80 by value of the firm. We calculated this method, NI approach, using these formulas. And traditional approach is also one more. So now I want to explain this graph of this method. So as per NOI method, we see the graph like this. So KD, cost of debt, remain constant, right? Here in this method, K is also constant. K is also, if the firm issue the higher debts, higher financial leverage, the KO is decline. KO is decline. KD means cost of debentures. KE means cost of equity. So whatever the changes happening in the capital structure, it leads to KO is decline, while the firm is increase as per this NNAT approach. As per this traditional method, is also graph is similar to this, right? As per this method, as per this method, right? As per this method, traditional approach method is also similar. Here also KO is up to certain period. Up to certain period, all are constant. Beyond that, after the point, there are changes are there. This approach favors that the result of financial leverage up to some point, this is the point, up to some point, KO and KO come down, wealth firm is increased. However, beyond this point, reverse trend emerge. The principal implication on this approach is that the cost of capital depended on cost of capital depend on capital structure and optimum capital structure, which minimizes this KO. So it is also relevant to say that up to certain points, the influence is there. After that, there is no much influence as per this traditional approach. The next method, NOI method, net operating income method. This method says that any changes happening in this leverage will not lead to any change in the value of the firm and the market price of the share. Any changes in the financial leverage. Any changes means what? If the firm has to issue the debts, if the firm want to mobilize the funds for through issue the debts, there is no influence value of the firm and KO. There is no influence as per this NOI approach. As per this NOI approach. The overall cost of capital also depends the higher degree of leverage. A higher degree of leverage. As a result, the deviation between debt and equity is irrelevant. As per NOI approach, the decision between the debt and equity is irrelevant. But as per these earlier two methods are relevant, this method is irrelevant. As per this approach, income, as per this approach, increase use in debts, which apparently cheaper affect by increasing the equity capitalization rates. So this happen, right? Whatever the change happen, also if higher debt is there, naturally equity shareholders are expecting higher return as per this NOI approach. So here the formula is calculated NOI by KO. V is equal to value of firm is equal to NOI by KO. So NOI nothing but net operating income. Net operating income by KO, cost of capital. NOI nothing but EB80 by KO formula. Second irrelevant method is Modigliani-Miller approach, popularly known as approach. So this approach, NOI approach, is defined are conceptual and lack of deviation significant. It does not provide operational justification for irrelevant capital structure. However, modeling and approach provide with, behavioral justification for constant overall cost of capital, right, or value of the firm. So here says that he suggested MM approach with tax and without tax. See that there is no. Hello, hello, right. Right. So this method says that without tax is also right. He says that as per MM model, the tax is there are some assumption. This assumption based that there is no not considered tax. Tax is an exemption, and here tax is included. Okay. Next, trade-off theory. Trade-off theory of capital structure refers to the idea that a company choose how much debt finance, how much equity finance to be used by the balancing the cost and benefit. Cost and benefit analysis is also there. Okay. So you can see that here the value of debt. So cost of capital, everything is there. Now we'll move to our study material. Okay. Wait a minute. I will show you our study material. Wait a minute. I will go to our study material. Wait a minute, please. And I think is not available. Unable to get this copy. Wait a minute. Business finance. Unable to get the study material, and we'll continue this another course. Right. So here also see that we'll go for this continuous topic. EBAT and EPS analysis. EBAT and EPS analysis. Okay. Uh, EBAT, EPS. EPS nothing but earning before interest and taxes. EPS, earning per share, means operating profits to EPS, earning per share. The basic objective of financial management is to design the appropriate capital structure which can provide highest earning per share and over the company expected range of earnings before interest and taxes. So EPS measures the company performance for the shareholders. The level of EBIT varies from year to year, and representation of success of a company's operators also differ for year to year. Right. So, however, EPS criterion ignore that the risk dimension as it is more a performance measure. So, how a company can measure is how much, what is the EPS of the firm, right? The sales growth is good. EBIT is also good. What about the EPS? Right? If EPS, the final outcome is of shareholder, equity shareholder, they see that what is the EPS of the firm last year, this year. They will compare that what is this EPA, what is how much amount is there. EBA analysis. Okay. First, I will show you this topic. First starts with say that sales, right? Sales minus variable cost. Variable cost. It is called as a contribution, right? Contribution minus fixed cost. So it is called as EBIT. EBIT. It is called EBIT. EBIT minus interest on debts. Interest on debts. Interest on debts. Now we'll get is EBT, earning before tax. EBT. Now minus the taxes. Minus the taxes. Now it is called PAT, profit after tax, or at earnings after tax, minus preference dividend. Preference dividend. Then final one is amount available to equity shareholders. Amount available to equity shareholders. So we will discuss the relationship between EPS and EPS analysis, EBIT to EPS. So how we can calculate this EPS? Amount available to equity shareholders, amount available to equity shareholders divided by number of outstanding equity shares. Number of outstanding equity shares will know that EP earning per share. Earning per share. So like that, this is the structure. This is the structure of a company. How the sales are increases. Sometimes whatever the amount is, it's not up to them reach this EPS, right? The firm is the highest debt, and see this, the preference dividend is there, and tax is also there, right? So here you can see that EBIT minus interest into tax rate divided by EI. So EI is number of outstanding equity shares, and here number of alternate two, right? So alternate one is only equity. All firms are equity firm. It is called levered firm. It is called levered and unlevered firms are there. So this firm is a combination of both debt and equity. This firm is all are equity only, right? So here you can see here also you can see that you can see the graph. So cost of financial distance is there. What we expected, what we expect, right? Next, picking order theory. So this theory is based on symmetric information. Symmetric information. Asymmetric information means information is not available to everyone in the same manner. Right? Symmetric means everyone get the same information, whereas this asymmetric information, only few people are in the information, others they don't have the proper information about the company products, services, or others, right? Which refer to situation in which different parties have the different information. Information asymmetric means different parties have different information about the company profit, about this company returns, company CEOs, company sales, and internal company directors, whatever there is some information is different for person to person. Right? Here the debt equity, trade-off theory is the debt equity. In the picking theory, picking order theory says that internal finance, debt and equity, how we can pick this, right? So here you can see that again, you can see that the company may have an excess over equity, and see that what we call over capital is a problem, under capital is a problem, right? The company has to maintain optimum level of working capital, and not this, company is required optimum level of working capital. The company maintain has excess is also problem, debt is also problem. Right? And you see that here we have one more topic in financial decision that is called financial leverages. Okay, leverage. So, and this is earlier I told you, explain this leverages. So, leverage nothing but is a debt. Okay, is a debt of a firm. Okay, leverage nothing but debt of a firm. Right. So here, what is the leverage? The leverage analysis says that two types: financial leverage. The firm has every firm has a two kind of risk: business risk and financial risk. Right. And I see that if the firm has a debt in their capital structure, there are two different types of risk is also involving business risk as well as financial risk. Right. So business risk is not. It is an external risk, sometimes internal risk. But financial risk purely is internal risk only. So leverage analysis, we are categorizing three types: operating leverages, financial leverages, and combined leverages. Combined leverage, right? So there are three different types of leverages are there, and these leverages are the purpose is different, right? So operating leverage talks about business risk, financial leverage talks about financial risk, combined leverage talks about total risk. Right. Operating leverage nothing but is talks about the business risk. So business risk, financial risk, combined is total risk. So financial analysis leverage represent uh, the influence of more influence of one financial variable over some other related financial variables. So one financial variable influenced with other. These financial variables may be cost, output, sales revenue, earnings, EBAT, EPS, others also. Right? Business risk and financial risk. So risk facing the very common stockholders in two aspects, namely business risk and financial risk. So therefore, the risk faced by these common stockholders, I think equity shareholders, is a function of these two factors, business. So let us see that in detail of what is called this business risk. So what is the called of financial risk? So business risk, it talks about it refers to this risk associated with the firm's operations. It is uncertainty about these future earnings of the firm. However, well, how well can operating income be predicted? Right? How the business see the company sales, company revenues. Okay, and what is the company's variable? What are the inputs are available? So, like the businesses are talked about initial part, which as I told you this earlier. So, sales minus variable cost, contribution fixed cost. So, this area we talked about will take the advantage of the fixed cost, right? Take the advantage of how much the firm can taking the advantage of this fixed cost. So, it is called operating leverage, and it is see up to here it is called as a business risk, and up to here called as a financial risk. So financial risk refer to the additional risk faced by the firm's shares as a result of debt use, traditional additional risk as shareholders where of the company debt is additional. Right? If higher debt, naturally it's a higher risk is there. Higher debt, higher risk is there. Lower the risk, lower is there. How much the firm is facing this risk? How much firm is facing a risk? Okay. So as I told you earlier, so there are three different analysis are there for financial leverages, operating leverages, and combined leverages. So combined leverage, including both financial and operating leverages. See here how it will calculate it. Profitability statement first starts with sales, then less variable cost minus variable cost. We'll find out contribution. And after the contribution, we will deduct fixed cost. Remain fixed cost amount deducted. We'll get the answer is EBIT by EBIT on operating profits. Operating profit, what we next step is minus interest on debt. So we will call as EBT, earning before tax rates. So here is if interest rates are fixed. The advantage of is here interest rates are fixed and here fixed cost is fixed. To taking these advantages, taking the advantages is EPS increase or decrease. Okay, taking advantages. So combined leverage means both financial and operating leverages. The tax part is there, profit after tax. Profit after tax is there. Then preference dividend. Number of equity shares available by number of earnings available to the equity shareholder by and number of equity shares will get EPS per share, earning per share. Right. So you see that few of these formulas for operating leverages. Operating leverage may be defined as the employment of assets in fixed cost in the hope that the sufficient revenue will be generated to cover all its fixed and variable costs. Right here, the operating leverage is calculated using the formula is EBAT as contribution by EBAT. Contribution by EBAT. So you can see here formula we can see that here in this table. Right. So operating leverage, what is the formula? Contribution by EBAT. So contribution by EBAT. Right. C by EBAT. C by EBAT. It is called operating leverage. Explaining the relationship between contribution and EBAT. Then the second one, we also calculated percentage change in EBAT by percentage change in sales. Degree of financial leverage. If you want to calculate degree of financial leverage, we can apply percentage change in EBAT by percentage change in sales. If it is operating leverage and EBAT, if it is a negative value is there, the operating at lower than the break-even points. So operating profit lower than this break-even point. Here, EBAT equal to minus EV. Value form is EV is there. But it is inflated undefined. The operating at a break-even point. So in break-even point, EBAT equal to 0 means no profit, no loss point. When EBAT operating profit is equivalent to EBAT equivalent to 0. So in this case, the firm is unable to get any additional profit. Is no profit, no loss point. So here you put the positive. The operating at a higher level than the break-even level, EBAT is a positive. Okay. So now we will move to this financial leverages. So financial leverage may be defined as the use of debts within fixed cost in order to increase EPS, earning per share. In other words, it is a use of company's funds on which it pay a limited return. So here the formula is EBAT by EBT, earning before interest and taxes by EBT. Right? So earlier financial leverage what we calculated contribution by EBAT. Here EBAT by EBT. This formula we can apply for calculating this EPS. Okay. Then we move to we'll apply this user formula for degree of financial leverage. Percentage change in EPS by percentage change in EBT. So here if it is positive or negative financial leverage. If it is a positive financial leverage, so see that EBAT level is more than this fixed charges. After paying fixed charges, the amount available to the excess amount is there. So EPS will be same, but direction is EBAT. Okay. But is indefinite and undefined, the operating at financial break-even point and no loss point is also there. So EPS is negative. Okay. So the formula for, as you told earlier, I told you, calculation of combined leverage is operating leverage into financial leverage. So degree of financial combined leverage is calculated using the formula of degree of financial leverage into degree of operating leverage. So combined leverage, it talks about the total risk involving in the business. So it may be defined as the potential use of fixed cost in both operating cost and fixed cost. So both cases we can use this fixed cost is remain constant, which magnifies the effect of sales changes in the same EPS of this firm. And combined this formula. Then financial leverages as trade, trade and equity. Financial leverage as a double-edged sword. So financial leverage indicates the use of funds with fixed cost, like among debentures and preference share capital, along with equity share capital, which is known as trade on equity, which is known as trade on equity. When the equity capital funds is related high composition to the equity capital. But here also same, but here also same that what we call uh, financial leverage. Here also can say that same portion. One hand, the cost of fixed cost of funds less than the return on investment (ROI). The financial way help to increase the return on equity and EPS. However, the cost of debts is more than the return. It will affect the return on equity and EPS unfavorably, means the negative. This is why financial is also known as double-edged sword. Okay. Also, we discussed this investment decision. One more topic is pending in financial decision. It is called cost of capital. Okay. Cost of capital. Now we move to cost of capital. Right. The chapter cost of capital. So, as a major financial manager, is to procure the funds and effective utilization of the maximum wealth. However, he or she is required to select such a capital structure in which the firm wealth maximization for the purpose. First, he or she need to calculate various source of finance. The cost is return expected by this provider, the capital common, right? So capital structure consists as a combination of both all these sources cost. Cost of debts, cost of preference shares, cost of equity, cost of retained earnings, and a combination of both combination of cost and weight of each source will calculate weighted average KO, cost of capital. What's the meaning of cost of capital? The meaning of cost of capital is that the return expected by the provider of the capital, that is shareholders, bankers, and lenders. So cost of capital is also called as hurdle rates, standard rate, target rate, cutoff rate, capitalization rate. Like various terminologies are using is all are interchangeable word. The cost of capital is very clear. The return expected by these providers, nothing but finance providers, how much they are expected. Okay. So here, what is the significance? The significance of the cost of capital is very most important. Any kind of decision, either dividend decision, finance decision, investment decision, any decision. This is a very key point is cost of capital. So what here the scope is designing optimum capital structure, taking appropriate financial decisions, and evaluation of investment options. Investment options. So what are the factors determine this cost of capital? Cost is uh, Cost is not the same amount which company can pay or actually pay. So rather it is expectation of shareholders. So expected shareholders is knowing the very difficult. They are expecting depending upon the various factors. right? So how to calculate the cost of capital? The cost of capital can be calculated by the way identify the various source of capital. What is the source of long term? Like inflow of amount received at the beginning, outflow of payments of interest, dividend, redemption at the end. So like these are the sources of funds, and thereafter use trial and error method to arrive at the present value of cash flows as equivalent to present value of influence, which is basically IRR, internal rate of return method. Cost of equity, cost of long-term debts. So now we move to one by one, we'll calculate a one by one individual cost. First one is cost long-term debts. The long-term debt. So do not confer about ownership to these providers to finance. So debt providers do not participate in the capital, right? So cost of capital, cost of debts, cost of irrelevant theory, cost of relevant and irrelevant theories are there. So this is formula we can apply well for that. If these debentures are redeemed, so debentures are also we class we discussed debentures are redeemable debentures, convertible debentures also there. So out of which, if the debentures are redeemable, so we can use the formula, right? RV minus redemption value, NP minus the proceed net proceed value, right? With the formula, easily calculated this cost of debt, in the individual debts, and we also calculate this what we call uh, what we call other debentures also, right? Using this present value method, yield maturity method also we can use. And see that this first step, identify the cash flows. How to identify? After meeting all expenses, the cash flows are available. The second one is calculate NPV of cash flow is defined about the use. Okay. So tomorrow we'll continue. Now we'll stop here.